5-day moving average and the 10-day moving average. Now, these two indicators they can work like magic, almost like magic, because you are the magician, if you like. You have to work with these indicators. Now, bear in mind that indicators are just a tool to help you know when to get into a trade and get out of a trade. So the idea is that you want to get into a trade when the price is low, and then you want to get out of the trade when the price is high. So that's for those buying. In options trading, when you buy a call, you're buying a call of a stock, of an underlying stock, because you believe the price of the stock is going up. You make money when you buy a call, when you buy the option at a low price and sell at a high price, because of course you expected the price of the underlying stock to go up. You buy a put because you believe the price of that underlying stock is going down. When the price of the underlying stock goes down, the price of the option goes down. So you're going to buy high and sell low. One thing I'm going to really recommend is you really have to dedicate a chunk of your time learning all these terminologies. That's pretty much how I started, listening to videos, reading books, and hearing all these different terms. And for every single term, I would look it up to find out what on earth a put is, what an option is, what a Bollinger Band is, and the like. So really, you really have to be committed to learning. No one video can do it, no one book can do it, and learning to trade options has to be hands-on. So you have to have a platform where you can actually practice trading paper money, and the perfect platform that I know of is Thinkorswim. So here you are, Thinkorswim. So if you Google Thinkorswim, you'll be able to download it onto your laptop and onto your computer, whatever your device, and then you log in. So here's me logged in. So when I talk about the underlying stock, I pretty much, let me expand this a little bit to show you my watch list. So these are pretty much stocks that I like to study, I like to trade, and not because of anything in particular other than my mentor and the people I follow tend to trade these stocks. So we have Nvidia here, Amazon, Netflix, Tilray, Facebook, Tesla, and so on and so on, Apple and Google. Okay, so many things to learn. So let me try and start from the beginning. Up here we have, if we click on this bottom little ticker here, we have the different time scales we can observe or we can create charts on. So right now we have the monthly. So when we say the monthly, if you look down the bottom here, this is January 2019, and this here big green candlestick indicates the month of January so far. The one just before it, if you look below my vertical line here, you see it's December 2018, and so on and so forth, all the way to March. And it basically shows you, basically in the month of, what's this one, February, the price of, okay, I'm going to change this, my underlying stock to Amazon, just for the sake of, for training purposes. So back in February, Amazon, let me see, started off at this price. If you look to the right of this, my horizontal line there, $1,400 and change. By the end of the month of February, it was up to $1,520 or thereabouts. The second month, it went as high as, let me see, $1,612, but closed by the end of this second month of March 2018, closed at this lower price. So basically, your red candlesticks indicate the fact that there was a decline in the price of the stock. and the green candlesticks show that there was an increase in the price of the stock. So really what you want to do at this point, for those of you who are really new to all these charting and candlesticks, you want to Google candlesticks and you want to really study up on how you study them, how you read them and interpret them. So that's for the month, a monthly chart. And of course here we can get a daily chart, which looks a bit like this. So now once you pull up a daily chart like this, now this is a lot of days. Every candlestick represents a day. On the monthly chart, every candlestick represents a month, and so on and so forth. Now we may not be interested in all these days. One good thing that this does, looking at this big bird's eye view, is it gives you an indication of what was going on over the past, how many days do we have here? I don't know, whatever number of days. We have about a year's worth of days here. So it gives you an idea that over these days, the price of Amazon was going up. About here, the price came down, up, down, up, down, up, down. Now, it also shows you the highest point the price of Amazon has been in the past so many days. And it usually will show there, the lowest point. Okay, now we're going to expand a section of this graph because really I just want to show you my indicators. So we highlight a section, release, and there it kind of zooms in. And okay, my white lines are my Bollinger Bands, and basically Bollinger Bands are price levels. So there's a computation, some kind of formula. I'm not going to get into technicals. I don't really care about the technicals per se, but the general idea of these Bollinger Bands, the white bands, is that the price of this stock generally travels within the bands. About here in the month of October or so, it fell out of the band, but because of the way of the Bollinger Band has been computed, generally the price of the stock tends to want to go back within the Bollinger Band. So here it came out for a couple of, what do we have? It's a daily chart. So a couple of days and then it pops back in. Okay, now let's look at the trend. We see here from about above the white midline of the Bollinger Band, it travels down, hits the base of the Bollinger Band here, travels up, hits the top of the Bollinger Band, travels down, pops out of the Bollinger Band, pops back in, attempts to go up, but doesn't even get to the mid Bollinger Band, heads down again, pops out of the Bollinger Band, pops back in, tries to head to the top of the Bollinger Band, doesn't quite make it, a little over the midpoint of the Bollinger Band, it travels down again, up and down, and that's basically what the Bollinger Band helps you to kind of see, that the price movement of the stock that you're interested in, the underlying stock, generally will travel within the Bollinger Band. So stick with me with this thought. You want to buy low and you want to sell high. Now, because you have understanding that the Bollinger Band is like a womb, it's a womb for the price action of the underlying stock. And all in all, the price of the stock travels within the Bollinger Band, up and down. You want to buy low, you want to sell high. So let's say here on this day, the 26th of October, this long red candlestick, at the end of the close of this day, the price of the Bollinger Band, the price of the underlying stock, comes out of the Bollinger Band at this point, and at the end of the day, it closes right here. Right here is a good point to buy. Why are you going to buy? Because you have understanding that the stock likes to stay within the Bollinger Band. So it's popped out, it's going to go right back in. So the next day, what happens? Dips a little lower. But for those who really understand Bollinger Bands, all in all, this price will want to jump back in. So after another low day, well, it was a low day, but the stock price rose up higher and closed right here. By the next day, if anybody bought this option at this point, or even if you're into buying stocks. You buy at this point, but by the close of the next day, you bought at, let's look to the right. You see the gray number to the right there, 1531.78. You buy at this point, or you buy an option, a call option, because you buy call options when you know the price of the underlying stock is going up. So we know it's going up because it's out of the Bollinger Band. It's dipped below the lower Bollinger Band. So you buy at 15, what was that? 1531.78. By the close of the next day, it closes right at this point, 1597. You've made a little bit of money. Now, because you also have the underlying, you have the understanding that the price will generally try to move up to the top of the Bollinger Band. But over the next few days, it moves up and up. And at some point, which you would have predetermined, see, the thing is, before getting into a trade, you need to have predetermined, maybe you want to make 50%, 25%. You're going to have an idea of when you want to get out. It's so easy to get burned if you don't have an idea of when you want to get out. Because here, you can see these past 3 days, the price of the stock kept on going up. So now you're making money on whatever you bought when it was down here or down here or up here. You're making money, but at this point, the end of this day, you're closing a little lower. By the next day, you're closing lower again. So the idea is to, especially when you're just learning, learn to go into a trade with the idea that you just want to, with the idea that you're new and the understanding that you're new to it and you can get burned, because as quickly as the price goes up, it can also dip down. And you just want to be able to make that little extra, the 10%, the 15%, maybe even 5% to start with, and then you exit the trade. So that is the general idea behind Bollinger Bands. Now I'm going to take it a step further, because now I'm going to move into the moving averages. So the moving averages, this yellow line is the 10-day moving average. If we right-click on this line, it tells you right here that it's the moving average exponential. In this case, it's the exponential moving average. You have a simple moving average as well. And it gives you here this middle number. It's the 10-day moving average. And if we click on the blue one, it should tell us it's the 5-day moving average. So basically, the average of the price of the underlying stock over the past 5 days and over the past 10 days. You always want to buy when the smaller, indicator, the 5-day moving average, crosses over the 10-day moving average. That's called a golden cross. So we're going to look for, let me look for an ideal spot right here. Now, if we look right here, which is the 7th of November, the day before the 7th of November, this green candlestick, these two levels, the blue and the yellow, you can see the gap between them is reducing. So you can see the blue one, the 5-day, is slowly increasing. And by the next day, it crosses over the 10-day moving average, which is the yellow one. That's a good point at which you want to enter. And so you buy your calls, you're expecting it to go up. And by the end of the day, you bought at this point. If you look to the right of this horizontal line, it says 1658.22. By the end of the day, it's gone up 1751 or 55. Okay, you've made a little money, you jump out of the trade. Let's look at another point at which the blue 5MA crosses over the 10-day moving average right here. Again, I'll try and expand this section. Yeah. Right here, you can see it right here. So this day, just before this is the 27th of November 2018, the price of Amazon closed 1581, and we can see at the close of this day, you can see that the blue, the 5-day moving average, is getting ready to go and cross over. It hasn't quite crossed over. It's possible to buy at this point, but there's a risk of it not crossing over and for the next day for the stock to decrease. So usually to play safe, you want to wait until there's this crossover. If you look at the bottom of my vertical line, you can see it's the next day, 11:28. So the first few hours of 11:28, of course, I'm using a 10-day interval. Let's use a smaller interval. Let's use let's use a 15-minute interval. So if we use a 15-minute interval, every candlestick represents 15 minutes. And I'm going to look for a point. Oh, this is a beauty, this one right here. So I'm going to highlight Wednesday into Thursday. And look what happens here. The market opens. The gray area, by the way, is the pre-market. This is before the market actually opens. Price action is kind of moves around, and it is, kind of charted and tabularized here. But really what we're interested in is when market opens, because options aren't in play until the market opens. So market opens, and after the first 15 minutes, because it's a 15-minute time interval we're at, after the first 15 minutes, look at this. The price opens at this bottom of the green candle, and within 15 minutes it's moved up. But the most interesting part is, because as it's moved up, it could equally, in the next 15 minutes, it could go down. But the fact that our blue line crosses over our yellow line is a good indication that, it's an almost certain indication that in the next few intervals, the price is going to go up. So you purchase at this point, and then you sit back and watch. And you watch 15 minutes, it goes up. 15 minutes, it goes up. 15 minutes. Now you can stay in here until the blue line crosses back down. So we have here 50 minutes, and then here the price comes down, the price comes down, the price drops down. But if you notice, even though the price has come down within these 15 times 3, 45-minute interval, the blue line is still above the yellow line. That means we're still in play. So you don't sell, you don't exit your trade right now. You stay in there. Yes, it's come down a little bit, but you need kind of like not to get scared and bail out too quickly. Of course, if you bail out here, you still made money, because look, you bought here, you sell here. But if you really want to kind of hang in there a little longer, then you kind of wait it out, and you wait it out until you can see about here. You can see there is a reduction between the gaps. Momentum is slowing down. The price is going down. And at any point here where you see this closing of the gap between the blue and the yellow, you want to get ready to exit. You can already exit already, because you can see now, the price is kind of, zigzagging. Is it going up? Is it going down? It's uncertain. The minute the blue crosses back down, you just get out of the trade already, and you've already made money. And that actually helps you. The 5MA actually gives you a clearer picture, a more precise timing on when to get in and get out. The Bollinger Bands gives you a general idea that when there's price action at the bottom of the Bollinger Band, the white band, generally speaking, the price is going to go up to the top, and generally speaking, it's going to come down. But you can see here at this point, it doesn't come down. Amazon's having a great day. There's great confidence in the stock. People are buying, it's pushing the price up, and it's looking good. And so it keeps going up. It keeps going up, and that is the general idea. Excuse me here. So that's the general idea. And there she goes again. Twice my mouse has dropped. Pardon me. Okay. So you can see that the price goes to the top of the Bollinger Band. It doesn't immediately come back down. It kind of hangs at the top. So it's hanging above the mid Bollinger, the white line in the middle. It's hanging up there, so it doesn't come down. Now remember, I said generally the price wants to go up to the top of the Bollinger Band. Generally it wants to come down, but there are times when it's going to buck that trend. It's going to decide, no, I'm not coming down, I'm staying up. The moving averages is what helps you know when to stay in a trade or to get out of the trade. And that's all I want to talk about in this video. I try to keep each video kind of as short as I can, and this one's already running long. In the description box, I'm going to leave a link to Think or Swim for those of you who want to really get into this and start paper trading, Thinkorswim is the platform, is your go-to platform. I'm going to leave another link to the platform that I kind of favor for trading, and that is Tasty Trades. So click on it. That will actually set you up to open an actual trading account for those of you who are actually ready to start trading with your money. And I'm also going to leave a link to a little book I'm writing that basically tells you things that I have learned, basic principles that I have learned in this my option trading journey. So with option trading, you really need to allocate time of your life to learning it, because there's so many different aspects, so many different indicators, so many different ways to make money, and so many different ways, probably a lot more ways to lose money. And you really want to be sure that you're on track such that you're making money, maybe not all the time. I don't think there's anybody who makes money in the stock market all the time. You will always have those days when you lose. But the key is to lose as little as possible and to make as much as possible. I hope this video has helped you a little bit. And if it has, click the like button, drop me a comment, and click on the book, the PDF. It'll download the book. And with the book right now, I've got about 7 or 8 points, principles that I have learned. And my goal is to get to about 15 different principles that I have learned that hopefully will help you not make the same mistakes that I have made in options trading. And it's been really nice getting back to you all. I have been away for a while, but that's only because I have been so entrenched in my options trading courses and learning, and I encourage you to learn as well. And I will catch you on the next video, so keep learning.